and welcome to Gothenburg. And the title of the presentation will give you some hint about the areas I'm going to cover, about whether old gold is really there, and for each of the two categories, the evidence to suggest that it either is or may not be. So ETFs and central banks, exchange-traded funds and central banks, is the gold really there? So as Torgny mentioned, the Bank of England vaults under the Bank of England in the City of London. There's about 10 different vaults, and they're said to contain about 400,000 bars of gold, which is about 6,000 tons of gold. And within the vaulting network in London, there are also about 7 commercial vaults. There's a HSBC vault, JP Morgan vault. Then there's 4 vaults run by what's called the transporter and security operators, such as Brinks, Malcolm Mitt. And all the gold that's in those vaults has to be of a certain standard, and it's called the London Good Delivery Standard. These are the large bars of gold that people would be familiar with from looking at documentaries about gold vaults. So gold-backed exchange-traded funds are an asset class that has grown immensely over the last 15 years or so, from a position of 0 prior to about 2003. ETFs in general, exchange-traded funds, are an asset class that was devised to allow people to trade securities that represent underlying assets. And this could be any type of asset, either like a stock or a bond or a commodity. So the ETFs really try to replicate the exposure to, say, equity index like the S&P, or else a bond index, or else maybe a diversified portfolio of commodities, including precious metals, gold, silver, and oil, and livestock, and agricultural products. So there is such a huge amount of ETFs out there at the moment that there are whole industries of research analysts just covering ETFs as well. And these ETFs, like as a generic name, it can actually refer to an investment trust, a fund, a bearer note, which is traded on exchange, or a bond. And we'll go into a little bit more detail later about the various different structures. The first ETF really came onto the market in 1993. It was called the SPY. That was the ticker symbol. It was the S&P 500 ETF, and that really blazed a trail in creating the ETF industry. The first gold ETFs came on the market the first one came on the market in early 2004 in Australia, actually, on the Australian Stock Exchange. It was called Gold Bullion Securities, GBS. That was eventually taken over by a London company called ETF Securities. A few months later, in November 2004, the very famous and large gold ETF called the Spider Gold Trust was launched. Its ticker symbol is GLD. A lot of people know it as the name GLD. Initially, that was called the Street Tracks Gold ETF until around May 2008, when it was rebranded as the Spider Gold Trust GLD. But there are a few other larger gold ETFs which people might also be aware of, such as the iShares Gold Trust, based out of New York. And then there's the Zetra Gold Fund, which is based in Germany, but trades on the Deutsche Börse. And there are now some new gold ETFs from a company called Source in London, Source was originally created by Morgan Stanley, Goldman Sachs, and Merrill Lynch. Then there's ETF Securities, which is abbreviated as ETFS, a little bit confusing, and they're quite big, and they got 4 or 5 different gold ETFs. And then Deutsche Bank have their own suite of about 5 different gold ETFs. Some of them are only pitched at various investors in different countries, so they're not all available to everybody. Some of these big ETF providers will have a version for the US, denominated in US dollars, and another one in maybe euro for European investors. Then there are a few big Swiss ones. One is called ZKB, Zurich Cantonal Bank, and then there's another one by the private Swiss bank, Jules Baer. But so really, from 2004 until now, that's about 14 years, or 13 years. So these ETFs don't really have a long track record. they've operated in an environment which admittedly has been a bit volatile back in 2008, 2009, but there's never been a situation where we can see what would happen if the price of gold, physical gold, detached from the price of paper gold, and how these particular vehicles would react and how they would be priced, because they're all in general priced off the LBMA gold price, which is the auction that takes place every day in London. So these particular vehicles, they trade continuously throughout the day, but they're valued based on the LBMA gold price. And so, for example, the iShares Gold Trust was only launched in 2005. The Zetra Gold Fund was only launched in 2007, and the source ones are really even more recent. So these particular products, even though they're very in vogue at the moment, don't really have a very long track record compared to physical gold, which has 1,000 or longer, 1,000 years track record. So really, at this stage, it's probably best to say that I think that all of these gold-backed ETFs actually do have gold. I don't doubt that they do have gold, because legally, the way they're structured, they would have to have the gold that they claim to, or else it would be illegal. It would be misrepresentation. So they do hold gold physically in vaults that back the structure, the fund that owns the gold. And every twice a year, they have official audits. They have a semi-annual audit, and they have an annual audit where independent auditors will go in, such as Inspectorate International, and count all the gold bars and weigh some of it to make sure that it's what is said on the asset valuations. And this brings us to what we call a wait list. A wait list, or a gold bar wait list, is a list of all the bars in a particular holding, which uniquely identifies each of those bars. And to be able to uniquely identify a set of gold bars, you would need details like the refiner name, the finance content, the gross weight, the fineness of the bar, the year of manufacture, and the serial number. So I think that all of these particular funds have gold. A lot of them hold their gold in the two vaults in London operated by HSBC and JP Morgan. So, for example, the Spider Gold Trust has its gold in the HSBC vault in London, and the iShares have their gold in the JP Morgan vault. And every day at the end of each trading day on their websites, the updated wait lists appear in PDF format, and they're actually hundreds of pages long, and they have a line for every single gold bar that's held in these particular funds. So what type of gold, what are the structures of some of these ETFs? Like GLD, the Spider Gold Trust, and the iShares IAU, they're listed in New York on the NYSE, and they had to register with listing requirements with the Securities and Exchange Commission in the US to be able to be listed, and they trade every day on the NYSE. They're set up as grantor trusts. It's quite an archaic type of legal arrangement in New York law, and they're really what they call non-managed investment pools. So they're just pools of assets that an entity sits above that and owns the assets, and then that entity issues units to the shareholders or the unit holders who then buy them. The way that these particular funds are all set up is that they will have a sponsor, which is really just the entity that decided to launch the product. And then they will have, because they're holding physical gold, they'll have a custodian, a physical custodian. They'll also have a trustee, which looks after the trust and is meant to be independent to make sure everything works the way it's meant to work. They have a thing called a trust indenture, which is a legal agreement deciding what each of the parties, their responsibilities. And they will also have a marketing agent. So the Spider Gold Trust, the marketing agent is State Street Global Advisors, and their job is meant to be promoting the product all around the world. Like GLD, for example, trades on 5 exchanges. It trades in Tokyo, Singapore, Hong Kong, and in Mexico City even, and then in New York. So the two big ones that most people might be familiar with are trusts, grantor trusts, and the unit holders actually have responsibilities like voting. They can have voting rights and so forth. So every time that they need to change the trust indenture, they would have to go out to the people who actually bought the Spider Gold Trust thinking they were buying gold, but they then get phone calls from proxy voting agents saying you need to vote on this issue. So that's another issue to be aware of with some of these products that brings back to mind the fact that they're not gold, they're very sophisticated financial products. And they also have another entity called authorized participants, who are the market makers who actually create and redeem baskets of securities by transferring unallocated gold in London to the custodian, who then goes and allocates that gold. And likewise, when they want to redeem baskets of securities, they will collect those on the market, swap those for gold with the custodian, and then transfer that to their own accounts. But what I did here was list some of the different types of ETFs, just to give a flavor of how complicated some of these things are. ETF securities call their products undated, unlimited recourse debt securities. Xetra Gold, it trades on Deutsche Börse, and I think in the Austrian stock market and in Luxembourg, they're called exchange-traded bearer notes. So really, like, whoever owns them is the owner. They don't need to be in anyone's name. The source physical gold, they're called PTEC, that's the abbreviation. They're collateralized exchange-traded certificates. So they're collateralized with the gold bullion, which is sitting in the vault. And Deutsche Bank call theirs secure limited recourse obligations with metal entitlement. So really all of this just gives a flavor for the fact that they're quite different to holding gold. And they will say in their marketing literature that they're really giving you the exposure to gold, but they're not really. What they're doing is they're just giving you exposure to the price of gold. So what I did quickly was look at some of the statements within the prospectuses of each of these products to say exactly what they do. So the Spider Gold Trust, its aim and objective, investment objective, is to reflect the price of gold bullion. Likewise with the iShares Gold Trust, to reflect generally the performance of the gold price, because these prices move in tandem with their net asset values, but they can deviate, and if the US dollar price of gold changes on a certain day during the day, these products are meant to track that. Xetra Gold, its aim is to participate in the performance of the gold market. ETF securities to provide a return equivalent to movements in the spot price, and Deutsche Bank to gain exposure to the spot price. So all of these products literally are set up to give people exposure to the gold price, which is the US dollar gold price. And as Torgny mentioned in his synopsis of the way that unallocated gold is traded in London, this US dollar gold price is the concerns are that it's affected by the huge amounts of synthetic gold and paper gold that are traded in the London market. So really what these products are doing is just tracking that US dollar gold price. So given that they're structured as very complicated types of vehicles, and given that their aim is to provide exposure just to the US dollar gold price, we're going to look now at some of the risks or concerns that people maybe should be aware of when thinking about what are these gold-backed securities and how they really differ from holding physical gold. So the one we just covered initially was that they just provide exposure to the price of gold and not to gold. You don't own gold when you hold these products. You own units. And the units are issued by the issuer or the trust. And the trust and the issuer own the gold in the vault. So, for example, like the Spider Gold Trust, the trust owns 830 tons of gold in the HSBC vault in London. It's called a effective entitlement. So you could argue maybe in a court of law that if you own some units in this particular GLD, you own gold because you own a very small part of a bar, but you don't actually own a small part of one bar. You own it. You have really a claim on the total assets of that particular trust. And it would be nearly impossible to go to a court of law as an individual and say that you own a part of the gold that's in those vaults. Another one that we touched on just previously was that when you buy these products, you're a shareholder. And there was an interesting case that came up in 2014 where the GLD trust indenture had to be changed. And they spent 6 months ringing all the shareholders, including the large institutional shareholders and the smaller retail shareholders. A lot of them were based in the US and Canada. So people were getting bombarded with phone calls late in the evening from these proxy voters like DF King and Broadridge saying, did you know that you need to vote on this particular issue? And they wouldn't give up until they had got 50% of the shareholders to agree to their change in the trust indenture. I think probably the most important thing about these products is that people maybe think that if you buy a gold ETF, that at some point down the line, if you really wanted to, you could convert your shares into gold. But this, for most of these funds, this is practically impossible. They don't even offer that option. There are a few exceptions, like the Zetra Gold fund run by Deutsche Börse. That allows people to convert their shares into gold, but it doesn't do so by converting the pool of gold that it holds. It holds a small amount of gold in reserve as an extra, an extra little pool of gold for people that might want to convert their shares into gold. And it holds this in the form of unallocated weight balance with a refinery called Umicore. And as of now, there's about 140 tons in Zetra in Germany, but only the equivalent of 4 tons has ever been converted. So they only hold about 1 or 2 tons in case people might want to convert. But if everybody did want to convert at the same time, that would be impossible because they don't have enough. It's not set up to be able to convert the underlying assets into gold for delivery. One of the ETF products, the gold bullion securities, also has another option of you can convert your shares into what they call unallocated gold balance. And then they did a deal recently with Royal Mint in 2013 where you can subsequently go to the Royal Mint with your unallocated balance and convert that into gold Britannias and gold sovereigns. But that's quite obscure. A lot of people don't know about that, and it takes about 2 weeks to do that. So it would actually be quicker to sell your ETF securities, get your cash, and then just buy Britannias or sovereigns if you wanted to do that. So in general, these particular products don't allow delivery. There are a huge amount of entities involved in running these products, such as the trustee, the custodian, the sponsor, the marketing agent, the authorized participants, and you even need a brokerage account to be able to buy these particular products. So you got straight away, you got 6 different entities involved, and if one of those has a problem, that can affect the whole fund. For example, back in March 2016, the iShares Gold Trust in New York forgot to register some additional shares that they needed to do prior to issuing those new shares. So there was a spike in demand for the iShares Gold Trust, and just before they released those new shares, they realized that they hadn't registered them. So they had to freeze the trading of that particular fund for a few days while they registered those shares for the first time. So that's just one example of the fact that they're quite complicated, and the prospectuses of these particular products are really complicated. I used to work in London for 4 years doing stock market portfolio management, working with investment funds, and we would have prospectus for each investment fund that we had created, and also the underlying stocks that we had in these portfolios. We'd have to regularly read prospectuses of new IPOs and so forth. But when I turned to look at the prospectuses of some of these ETFs, I'm not joking, they're actually a lot more complicated than the prospectus of a company or of a normal equity investment fund. And it just leads a lot of potential error for interpreting different legal clauses in different ways. So looking at some further concerns with these ETFs, most of them are structured that the quantity of gold underlying the particular fund declines over time. And the reason that is that they have to pay their management fee, or they have to pay their fees to the custodian and the sponsor. So every month they accrue expenses and they sell little bits of gold out of the funds to pay for those expenses. So every year this is the equivalent of about 0.4%, 40 basis points. But for example, with the Spider Gold Trust, which was launched in November 2004, that's been on the market for about 13 years now. And I did a calculation a few months ago that over that particular period, the amount of gold represented by each unit of the GLD is now 4.6% less than it was when the GLD was floated on the market. So you can imagine it visually as a little chip of gold is being taken off each unit of gold that's being held over time. Another quite humorous concern about these gold ETFs is that, as well as not allowing people to visit the vaults, they don't even say where the vaults are located. The London gold market is ultra secretive. The LBMA, which is the industry body really representing the banks and the refineries, which represents the London gold market, they really go out of their way to be very secretive. They don't tell people where these vaults are located. And if some people in the audience might be familiar with the New York vaults, which are connected to the COMEX gold futures market, at least in the case of New York, people know where the vaults are because they have to list where they are as part of the COMEX and the CFTC regulations, the commodity regulator regulations. But in London, we officially don't know where these vaults are. I did some work last year where I decided, just for the challenge, I'd try and find out where some of these vaults are located. And I did so by just lots of different strange ways of looking at planning applications, looking at old documentation, trying to pinpoint where some of these vaults might be. And I found, I think, probably 3 or 4 that officially people didn't know where they were. And we were at the LBMA conference in Singapore in October, myself and Torgny, and we were told by the head of one of the security operators that there was consternation when I published this data and they didn't know what to do, and they actually did a background check on me to go, who is this guy? Why is he releasing this data? So that was quite an eye-opener and a little bit scary because we felt a bit threatened that the LVMA were doing background checks about me. But on a serious note, if you did hold the GLD, you can't go to the vault because they won't tell you where it is. They do make a few exceptions for large institutional shareholders, probably because they're so influential and they hold such a big stake that they can't do otherwise. And that leads me to another point about some of these. When you read Bloomberg or Reuters about George Soros or John Paulson or Stan Druckenmiller, the big hedge fund managers, buying gold, they're not actually buying gold. They're buying the GLD. And so really they're just buying exposure to the gold price. So I always find it quite humorous that Bloomberg is saying that John Paulson from the Paulson hedge fund is buying gold. He's not buying gold. He's buying GLD shares. Theoretically, I think it would be possible for a large hedge fund to go to an authorized participant like Morgan Stanley or Goldman Sachs and say, I own 1 million shares of Spider Gold Trust. I need to convert this into physical gold. But that wouldn't be done through the trustee or the trust. That would be done as a side deal between the institutional hedge fund and the bullion bank, which would be the market maker. Likewise, because nobody knows where the vaults are and they can't go and see them, they don't know, there's no way of doing a personal audit, and practically there's no way of doing an audit of these particular funds because they hold huge amounts of large gold bars. And another point that people mightn't be aware of is that there isn't full insurance, or even like 5 or 10% of the assets aren't insured in these particular vaults, because the value of these funds is so enormous that they can't practically insure all the gold. And we were talking to a guy who used to be one of the heads of the World Gold Council, who's the sponsor of the GLD. We were talking to him in Singapore last year, and his argument was, well, they're ultra safe. No one's going to go to these vaults, so they actually don't insure the gold. That's what he told us. This next point, another concern, and it's quite a big concern about the particular ETFs that are storing their gold in London and sourcing their gold in London, is that they totally prop up and perpetuate the secrecy and the opacity of the London gold market. We really don't know where the HSBC sources gold for the Spider Gold Trust. They claim that it's already in their vault, but they won't say how that extra gold got in their vault. Sometimes they use sub-custodians such as the Bank of England, which leads us to believe that they're actually populating the ETFs with borrowed gold that they've borrowed from central banks. So this will become clear when I look at central banks, that there could be the same gold bar that a central bank claims it owns is actually sitting on the books of an ETF in London. And the LBMA really have a vested interest in keeping this ETF industry in London going, because all of the banks that it represents are the same banks that are the authorized participants and the custodians and the clearers and the vault operators of these particular products. So it's really like a closed shop. And we found in Singapore, when we tried to ask some questions, that they really weren't that keen to answer our questions about, like, easy questions about ETFs, how they really work behind the scenes, where do they get the gold from. People were just like shutting up. They wouldn't talk to us when we were trying to find out some information about that. And for something that people don't really, you're not holding physical gold, they're actually quite expensive. There are management fees of between 0.25% and 0.4% per annum. And that is, in my view, quite excessive for something that you're not actually holding gold. The argument of the ETF providers is that they're saying it's cheaper than owning physical gold, which you have to store, but they're not really comparing like with like. Like comparing a financial product where you have exposure to the gold price is not the same as saying I own gold bars in a vault that are allocated and segregated. So this leads me on to the point about, so on a really high level, what are the differences between owning physical gold and owning some of these gold-backed ETFs? So with physical gold coins and bars, you have full ownership of your bars and coins. You can leave them stored in a vault, or you can take delivery of them. You can, with Bullion Star, for example, you can audit your gold holdings on a daily basis through multiple different audit methods. The gold that you would hold in a storage facility like Bullion Star is fully allocated, and there are no counterparty risks. Because you own the gold doesn't have a counterparty, real physical gold. With these gold-backed ETFs, you don't hold gold. You only hold a claim on a pool of assets that the trust actually owns. You can't get delivery. You can't do your own audit. The insurance is very opaque, and there are a lot of counterparty risks. So turning now to central bank gold, this is an area that I think there could be a strong case to make that in a lot of cases, the gold that central banks claim that they have on their books isn't actually there. It's either leased out, loaned out, swapped, or is encumbered in some other way with multiple titles against it. Back in 1999, back in 2012, I was doing some research about IMF gold in 1999, and I found this document that was on their website, which showed that a number of large central banks in Europe had petitioned the IMF not to change their accounting rules. The IMF at that time wanted to split out two line items for central bank accounting into gold and gold receivables. Now, gold receivables refers to gold leases, gold swaps, And the IMF wanted to make it more, to bring some clarity around the accounting, to make sure that a central bank wasn't saying it had gold when it actually had a gold receivable. And the large central banks, including the Bank of England, Banque de France, Bundesbank, and the ECB, they were up in arms against this, and they petitioned the IMF in Basel not to make this change. And I think that the document that I found actually shouldn't have been in the public domain, but it was in the IMF archives at that time. And through a few channels, I got that published, and it became apparent that this was one area that the central banks were really cooking the books. And the fact that they were so up in arms about not wanting people to know what their gold receivables was suggests that these central banks are continuously lending out gold, swapping their gold for FX, for example, if they want to intervene into the foreign exchange market. So there is a lot of secrecy around central bank gold, and none more so than as regards central bank wait lists. So if you recall, the large ETFs publish their wait lists on a daily basis, and it's a very quick process. They just get a file, they upload it onto their website, and people can look at it every day. But the central banks, to my knowledge, not one central bank around the world has ever produced a gold bar waitlist. And I think the reason they're so against doing this is that they don't want people knowing the serial numbers of the gold bars which they claim to hold, because some of these gold bar serial numbers could pop up in, for example, an ETF. And there are a few gold researchers around the world who, believe it or not, spend quite considerable amounts of time tracking all the gold in ETFs. There's a guy in Australia, in Brisbane, called Warren James, and he has a day job as a technology professional, but his hobby, so to speak, is to he has a database of gold bars, all the gold bars that have ever flowed through any of these ETFs in the history of ETFs. And what he does is that if any new bar numbers come on into the lists, he will add those to his database. So I think central banks are very scared that if they produced a wait list and suddenly one of these bars popped up on an ETF, it would prove that the gold isn't where the central banks think it is or say it is. So I've spent, along with a colleague of mine, Koos Janssen, who blogs on the Bullion Star website in Singapore, we've spent quite a lot of time emailing central banks and asking them various questions about their gold, trying to improve the transparency of the central bank gold. And we did a number of emails to European central banks in Europe, where we asked them to provide a wait list. So I've got a few quotes from some of the email responses that we got from these central banks. I'll just go quickly here. So the Netherlands Central Bank: we do not intend to publish a gold bar list. This serves no additional monetary purpose. However, it would incur administrative costs, which is a total red herring excuse. The Austrian Central Bank: we are sorry to inform you that the National Bank does not publish a wait list of the gold reserves. The Central Bank of Ireland is one that I spent a few years actually toing and froing with, including freedom of information requests to try and get them to produce a gold bar list. Ireland only holds 6 tons of gold, which is a pretty small amount, and most of it is held at the Bank of England in London, or so they claim. So they claim that it's in custody and it's not lent out, but they were unable to produce a gold bar waitlist when I sent in a freedom of information request about it. They said the record concerned does not exist or cannot be found after all reasonable steps to ascertain its whereabouts have been taken. The ECB a few months ago responded to me. The ECB does not disclose this information about gold bar list. Some of you might remember that the Deutsche Bundesbank claimed to produce a wait list about, I think it was October 2014, but when they actually produced it or published it, it was missing all of the key standard information that any ETF gold bar list would have, such as the brand, the year of manufacture, the serial number. They just had a sequential serial number from 1 to 89,000, like in a spreadsheet, as if someone had just sorted and added like a counter. So going quickly back to look at what are actually waitlists. A waitlist has to have, if you look at the bottom here, here's an example from the iShares ETF IAU. So the 6 columns of data that are in every entry in these waitlists. It's the brand, for example, a PAMP gold bar, the bar number, the assay content, the fineness of the gold, the gross weight, the fine weight, and they even put in where it's stored. And the LBMA, we criticize the LBMA for a lot of things, but one thing that they do quite well is that they administer the quality of gold refineries and silver refineries around the world. And they administer what's called the good delivery list, where all gold coming in and out of London has to be of a certain quality, and it has to be of an approved refiner. So within their website, when they're discussing the standards for the good delivery list, they even go and say that every bar coming in and out of the vaults in London has to have a serial number, a real serial number, the brand and the assay and the fine weight. So the fact that these central banks come out with such ridiculous excuses that they can't produce a gold bar list is just fantasy. It doesn't make any sense, and it's quite infantile and frustrating that they send responses to us like this and they expect us to be happy with it. So I thought that I would focus quickly on the Swedish gold reserves. So your country actually is quite high up in the rankings of gold holders by countries around the world. It's actually 28th, which is pretty substantial, and it's in the realm of a very significant amount of gold. I did a quick calculation this afternoon, and the Riksbank's gold, 125.7 tons, is currently worth 44 billion krona. So it's not an insignificant amount of money. But the question is, I haven't, as of now, looked at whether the Riksbank would ever provide me with a gold bar waitlist, and probably after this they won't. But if anyone in the audience was interested in collaborating, we could approach the Riksbank and ask them, have they ever physically audited their gold? Do they have a gold bar waitlist? And I guarantee that they'll probably say, well, we don't have a waitlist, and they'll make up some flimsy excuse. But another concern about the Riksbank's gold is that the majority of it is held abroad in various usual suspect gold vaults, such as at the Bank of England, the New York Fed, the Swiss National Bank in Bern, and even in the Bank of Canada. So over a quarter of the Swedish gold is sitting apparently in the Bank of Canada vault, which is in Ottawa. But the concerning thing about the vault in Ottawa is that the Bank of Canada headquarters is undergoing a multi-year renovation at the moment, and everybody and everything has been moved out of that building. And I asked the Bank of Canada where they moved the gold to, because they hold gold on behalf of Sweden, Netherlands, Belgium, and one other country I can't remember. And the response I got from the Bank of Canada is that we do not comment on these matters. So I think Swedish people should in general be wary about where this 125.7 tons of gold is. And I just, as I was looking at their website this afternoon, I noticed an interesting point some of you might find interesting, that there was a quote, and they said, the Riksbank gold can be used to fund emergency liquidity assistance or foreign exchange interventions. So that really proves that even if they haven't sold some of the Riksbank gold, they will use it to raise capital in US dollars, maybe, or in Swedish krona, to fund interventions and stability mechanisms for the Swedish krona. So to wrap up, I think that ETF gold is probably all there, but the big uncertainty is where do they get this gold from? Because, for example, the Spider Gold Trust on a given day can say that it's added 15 tons of gold. Next day it might lose 2. On the third day it might add 27 tons of gold. And this is huge amounts of gold. And where are they getting this from? And touching on what Torgny had mentioned is that the bullion banks in London seem to have a pool of gold that they all dip in and out of. And there's even a theory called coat check theory that a blogger in the US, I think, initially put forward. And this coat check theory, it's like if you go to a club, you check your coat in when you arrive, and in the evening when you're leaving, you get it back. His theory is that some of these bullion banks are using the big ETFs to just store their gold temporarily. And when, so they'll have an unallocated balance of gold. They will then allocate that with the custodian. And then when they need the gold again, they'll check it out. And maybe if they needed to send to a Swiss refinery, because a lot of these bullion banks are involved in sending physical metal to places like China and Singapore as well. So, and then with gold lending, the fact that ETFs sometimes hold gold, which comes from the Bank of England, suggests that they're holding borrowed gold. With central bank gold, I think there's a huge potential issue that maybe comes to the fore in the next few years, that a lot of central bank gold isn't there. It's either lent out or it's been sold and they haven't reported the sales. So because there's total secrecy around this, and because gold and gold receivables are not split out on bank balance sheets, and I personally have little confidence in the published data that's published by an organization such as the World Gold Council or the IMF. So with that, I'll wrap up, and later at the very end, we're going to have a question and answer session. So if anyone wants to ask either about ETFs or central bank gold, we could have some questions then.